In this video, we are going to talk about some principles of valuation and capital budget for the levered firm. We're going to compare some valuation practices or techniques with and without debt. Let's start with adjusted present value approach. Just what it sounds like. You already know or seen how to do present value. And what we're going to do is see how the tax shield debt can make a difference. So let's start by introducing the concept. The value of a project to the firm can be thought of as the value of the project of the unlevered firm, that is a firm without debt. And then you can add the present value of the financing side effects, which we'll discuss in a minute. In other words, we're comparing the NPV without debt and what happens to the NPV if we add debt to the project. There are 4 side effects of financing. The tax subsidy of debt, in other words, that tax shield. The costs of issuing new securities, flotation costs, for example. The cost of financial distress. The more debt you add, then you are making the company riskier with a higher probability of financial distress. That's just one example. Or if there's it's also related to debt, but if there's a negative expectation or a bad expectation of the economy in the future. But either way, the more debt you add, the higher you increase the financial distress, especially it gets multiplied if there's a expectation of a bad outcome in the economy in the future. Subsidies to debt financing. So the tax subsidy is the tax shield. Subsidies could be other incentives out there, for example, from the government that wants to promote investments in a certain industry. Then they may either have grants out there or guarantee loans, which then lowers your interest rate, etc. So here's an example so we understand. Okay, so in this example, there's the company without debt. So if there's no debt and also no preferred stock, by the way, to keep it simple, if there's nothing else financing a project except equity, then your weighted average cost of capital is just the cost of equity. There's nothing else being used for capital, so there's no need to calculate the weights and the cost of all of them. So in this case, they're saying that the cost of equity is 10%. So no need to calculate weighted average cost of equity. The weighted average cost of capital, because there is no debt, there's no preferred stock. You just use a 10%. That's the only thing you're using. So that is your cost of capital. And if you do the appropriate discount, if you see here, there was an initial investment of $1,000. And then these are the cash flows expected over the years, discount it, add that 10%. And when you get the NPV, it turns out to be a negative NPV in this example. So if you are only going to finance this project with equity, you should reject this project because you got a negative NPV. However, when you use the adjusted present value approach, then you can compare the same scenario, but using debt, having debt. So in this case, the debt will be compared at 8%. Not compared. The debt cost of debt here is 8%, which when you apply the tax shield, and in this case, $600 out of 1,000, so 60%. So when you apply the tax shield, you're going to keep using the $600 because what you're looking for a dollar amount, so you can do a discounted calculation later. So you do is you take the tax rate, 21% times the dollar amount you're going to borrow times the cost of debt, which is 8% in this case. That means that there's a cash flow of $10.08 each year produced by the tax shield of debt. The net present value of the project under leverage now becomes this. So you had the NPV they calculated for the equity side of 1706. And then what you do is you apply the same process you see here, but with the $10.08 over 4 years, you do the discounting with the exponent of 1, then 2, then 3, then 4, and then you add them together as you would. And what you get is that this present value, that's all this is here, a present value calculation, becomes 33.99 positive. So when you take the 33.99 positive present value of this tax benefit, to put it that way, against the negative 1706 that came out of the equity NPV, you actually now have 1633 as the NPV of the project, the present value of the project. So now you do have a positive value, a positive NPV. So the lesson learned is that sometimes borrowing is good, it adds value. So you wouldn't do it on equity alone, but if you do it through debt financing or with debt finance, I should say it's a combination, you get a positive NPV, and now the project can add value if you do that approach. Now, in comparison to using the weighted average cost of capital, let's say that you do this same approach of $600 in debt. This is what the numbers will look like. So you have 40% in equity, that's $400, and 60% of debt, that's a $600, right? Let's go ahead and cover the debt one. I'll explain the difference here in a second. So then you do the 8% of cost of debt and then the tax shield. These two together give you the after-tax cost of debt multiplied by 0.6. And then you take the 40% of equity and the cost of equity. Now, you may notice that in even there's the same scenario, the cost of equity was 10%. However, when you added debt in the formula, the cost of equity went up. And there's a reason for that. When you add debt to a project or a company for that matter, when you add debt to the equation, the beta is going to increase, is going to get higher. So that increase in beta then increase your cost of equity. Makes sense? Debt adds risk. It adds more value, the potential more value, the potential of higher returns, but higher returns always come with higher risk. And that's what happens. And that's reasonable. Debt increases risk, but it can increase value. So if you go ahead and do the calculation with your weighted average cost of capital of 8.7%, and you do the NPV, you also get a positive NPV. Now, there are differences in the calculation of this approach. They both give you positive NPV, but do notice the difference in the actual NPV. And this is normal. This happens. These are different approaches. And one can be argued over the other, of one being better than the other for different reasons. And to be honest, there is no right way of doing it or perfect way of doing it. You just have to apply the methodology that makes best sense according to the project. It could vary by industry. It could be all about project specific. It could vary because of specific details of how the contract for that project is written. So that's part of the decision-making process, which one will make more sense to apply according to the project or the firm policies and practices or the industry. There is no right answer. It's a executive decision, a managerial decision that has to be made which one to apply. Some people do both, or there's other methods as well, and sometimes they do many of them and they just get an average. In this example, since we're only doing the adjusted present value approach and the weighted average cost of capital, it wouldn't be abnormal to just get the average of those two numbers and call that NPV. But it doesn't have to be that way. So valuation with a discount rate must be estimated. It's not just that it must be estimated, it's always an estimation. A scale enhancing project is one where the project is similar to those of the existing firm. Now, what is I trying to tell you there is that sometimes it's reasonable to use the risk factors for the cost of debt and cost of equity of the overall firm and apply it to the project, because a project is just pretty similar to what the company's already doing. Sometimes the project might be unique enough or different enough, or just have some details about it that makes it different enough where you should estimate the discount rate for that specific situation and not use the averages of the company. In the real world, executives will make the assumption that the business risk of the non-scale enhancing project will be about equal to the business risk of the firms already in the business. This is what I was saying. So it is not abnormal to say, this has the same business risk, so we'll apply the same discount rates. But it doesn't have to be that way. It's another managerial decision. Is it different enough, and should we adjust to it? No exact formula exists for this. Some executives might select a discount rate slightly higher on the assumption that the new project is somewhat riskier since it is a new entrant. That's true too. That could be riskier at the beginning, and halfway the project stabilizes, a lot of things have to come in play, and decisions got to be made, and adjustments are made without an exact mathematical approach. You just have to adjust according to experience, some other knowledge of economics, etc. The adjusted present value impacts. Subsidized financing would increase the present value. As mentioned earlier, subsidized examples are the government offers grants or guaranteed loans, which lowers the interest rate paid. All kinds of different things that can be subsidized, therefore lowers the discount rate, increasing the present value. Remember, as the discount rate goes down, present value goes up, and vice versa. Flotation costs will reduce APV. So as flotation costs, see that as transaction costs as another way to say it, go up, that's just more money going out, more cost, so less cash flow. So lower the cash flow, lower the present value. Financial distress costs should be considered. Going back, that as you increase debt, the risk of financial distress goes up, meaning discount rates would go up, and that reduces present value. There's some abstract here. Well, we do have calculations like Altman Z-score for probability of default and things like that. Still translating that to a cost of debt in this example that I'm using, how much should you increase the cost of debt aside of the yield to maturity of bonds, for example? What kind of premium should you add to that number based on financial distress? Or some arguments are made that the increase in equity beta already covers that, but just understand that it should be considered. Beta and leverage. Okay, so let's talk about this beta issue that was mentioned earlier, that as you add debt, the beta goes up on equity, increasing the cost of equity. So let's start with a simple base example where there's no taxes, just to understand the situation. So in a world without corporate taxes and with riskless corporate debt, in other words, no risk, beta zero, it can be shown that the relationship between the beta and the unlevered firm and the beta of the equity is this. So beta of assets, that will be like the beta of the entire firm. You can just say equity over assets times the beta of the equity. And the importance here is because we're saying that beta is zero, that assumption. And that is a fair assumption. The risk of debt it's for the investor, from the investor's perspective, it's very low because they have the first claim to cash on the company. And if not, then they can liquidate the company and get their cash one way or another. And it's a fixed payment. So it is reasonable to do that. Now, in a world without corporate taxes, we're not in the tax world yet. That's why you don't see a T anywhere in these formulas. With risky corporate debt, it can be shown the relationship between the beta of the unlevered firm and the beta of the levered equity is the weighted average, is what you have here, really. So if in the scenario where the debt does have a material beta, let's call it this way, a significant beta. And the reason I say that, because if you have a situation where the beta of debt is really, really low, even though it's not zero, this is kind of the assumption made in that situation. But when you do, it's just a weighted average. This represents the weight. This represents the weight of equity. This represents the weight of debt. And they just multiply by the beta debt. This gets multiplied by beta of equity. You add them together. What you have is a weighted average of beta. Now let's go ahead and add the taxes. So in a world with corporate taxes and riskless debt, it can be shown that the relationship between the beta of the unlevered firm and the beta of the levered equity is following this formula. So now we have the weight of debt, but because we have the tax shield, we add this little piece here because now there's taxes involved, but interest is tax deductible. So if you take this impact that debt has on beta and you multiply by the beta of would have been on the unlevered firm, the firm without debt. So we're taking as the beta of a debtless firm, which is just the beta of equity of unlevered because of cost of capital, multiplied by the debt element that now you're adding. Now you get a new equity beta. Now notice this 1 plus here is important because no matter what number you get here, this is always going to be a positive number. This is always going to be a positive number. But when you put a 1 in it, it means this will always go higher from what it was here. So that means that the beta of equity on a firm with debt, and that's what's only down here, will always be higher than the beta of equity in a firm without debt. But how much depends, that's a lot of other stuff to discuss, but do know that. And this is how you calculate it. Here's a little bit more about if the beta of the debt is non-zero. Now we increase the beta from 0 to, so it's not risk-free. All right, here we have riskless debt, so it's risk-free in this example. But now it's not risk-free, then you want to add it, do it this way. Now notice there's more betas involved here because now you have a beta debt. All right, so you take the entire formula here compared to what it was with the risk-free, you'll notice how the impact becomes a little different because now you still have the weight of debt here. There's the debt to equity ratio. The differences between the beta of unlevered firm, which is just another way to say beta of equity on a firm without debt, minus the beta debt. Now keep in mind, typically the beta debt will be lower, so this number will be positive. And you got the tax shield there as well. But again, if you notice, this should always be a number, a positive number. This will be a positive number. And unless you have a real special circumstance, this will always be a positive number. So in the regular case, the beta of equity will always be higher than the beta of equity of a firm with debt will also be higher than the one without debt. So that's the message they're trying to tell you here. All right, that's it for this video. We will stop here and we'll see you on the next one.